Welcome back to DissedMedia, a startup story, the podcast where I take you along our journey of starting DissedMedia from the ground up. You get to hear all about our challenges and accomplishments as we either grow DissedMedia or go bust. Either way, you're going to have a front row seat to hear it all. And along the way, we're going to have some special guests who share with us their wisdom and insights and what helped them along their startup journey to success. So get ready as we get into it and try to help those get better at what they do. Welcome back, everybody, to DissedMedia, a startup story, the podcast where we take you behind the scenes of starting a business from the ground up. And week after week, we've been talking with people who bring in all kinds of different backgrounds, experiences into this. And we've talked a little bit about marketing. We've talked about SEO. But the topic that I find is the most interesting to a lot of people is when we start talking about capital, when we start talking about funding, we start talking about how do you get the money you need to get the things you want done accomplished. And we've ventured into venture capital. We've gone into crowdsourcing, crowdfunding, marketing towards crowdfunding. And today we're going to follow along those lines of how do we access capital, but how do we access capital maybe at a little bit of a later stage of business? However, still very necessary. Because when we talk about small business, a lot of times people think small business, coffee shop, little cart on the corner. Small business can actually be $100 million small business. And those businesses have needs. Even less than $100 million have needs. And today, we're going to get into a topic around getting capital for businesses that have a need, that have customers, that are on the pinnacle of growth, but need a little extra help to get there. So today, welcoming my special guest, Emily Reeves. She is a vice president of capital solutions at Bridge, has spent a lot of time helping businesses raise money, started with doing debt facilities and purchase order financing, helping mostly consumer product goods companies. But I think the lessons that we're going to learn here can be spread across a lot of different businesses because we all come across this need to have cash, to have capital. Emily, welcome to DissedMedia Startup Story. How are you?
I'm good. Thank you so much for having me here. You know, you call financing interesting. I don't know how interesting it is. It is definitely scary. It can be intimidating, but it can be what makes or breaks a business at the end of the day. So it is the lifeblood to a business, but it can sometimes be the most intimidating part of running a business.
It can definitely be confusing, especially when we talk about how do we get financed? Because I think for a lot of people, it's that fear of there's a lot of stuff you got to expose. People know about you in order to get financed. And I will say this, I definitely want to jump into all of that. But one of the things I like to do before we get started is get into a little bit of the background of who we're talking to here. And I would love to know, it seems that you've been at this and focused in this direction for some time, but how did it start? Where did you find that this consumer products goods hook that you have was something that you liked, and then marrying that with finance? I'm sure the finance thing probably came before the CPG stuff, but how did you get started along this path?
That's a really good question. So I did not know what I wanted to be when I grew up and thought I love to argue and I love to read. So I think law school makes a ton of sense for me. And I was actively studying for the LSAT and worked my way through college, supported myself and just took kind of odd jobs that built my resume as I was going through school, saw kind of what my friends who went down this legal path, what their lives were like working 60 hours a week and making no money at all, paying off these big student loans. And I fell backwards into a type of financing called factoring. So that's where you're selling your receivables at a discount to shorten your cash conversion cycle. And it is not something that anyone grows up wanting to do. No one grows up wanting to work for a factoring company, but it was the most fascinating job I'd ever had. I was talking to founders of all walks of life, people who had had a business for 30 years importing a chemical that helps paint stick to walls from Norway, to companies who were sealing the cement for every Dollar General when they repave their sidewalks and their parking lots. And I got to talk to thousands of borrowers who needed money, and I got to help them because factoring typically comes in when the banks don't help. So I'm learning the ins and outs of any and every industry you can imagine. And I'm actually being a piece of the puzzle for these businesses that they're having a hard time solving. And after that, I was hooked. From there, I started working at a company called C2FO, which does this great dynamic supply chain financing for their corporate partners like Walmart and Amazon and TJ Maxx. So I'm talking to all of these retailers now, these CPG companies who are on shelves, learning about their cash needs, where the financing is either missing for them or what they've done in the past that hasn't worked and what they're looking for in the future to grow. And then with Bridge, it all kind of came together because Bridge is a capital connector. We are a really easy to use marketplace that allows businesses to submit their business information and have lenders offer indicative terms in a really easy to use tech forward way. And we've continued working with corporate partners like Walmart and Dollar General and Lowe's. We've started to go into other verticals now, helping franchise businesses find financing. We also have an arm that helps hotel franchises find businesses as well. But Bridge just became the sweet spot for me, bringing my financial acumen and all the different loan products that I've worked with, and then specializing, kind of helping the niche corporate partners that we have.
I'm going to say that is awesome. And the reason that I say that is for the general consumer, for the person who just goes to the store and sees what's on sale, they have no idea how much it costs for those companies to get on the store shelf.
You don't want to go to a grocery store with me. I drive friends crazy. I'll be like, I met this company and I talked to them and this is a great product and you'll never believe this story. I'm a menace. I love it. I love everything that goes into finally seeing that granola on the shelf. It's not just the slotting fees and the distribution channels and the manufacturing. It's the founders' why. It's their story. It's how they built something that is now in someone's home is incredible to me. It's incredible.
It really is. It's funny. You're bringing back a lot of good memories for me. When I worked at Coca-Cola, we were mentioning before we got started here, I used to do sales and marketing operations and worked with a lot of companies from Disney to Walmart to Target to, I mean, you just name it. Any channel you can imagine where you've seen Coca-Cola, I've worked with a company or the leading companies in that space. And what's really cool, the people that are involved in all of that. But when I was mentioning like people don't understand the cost, I used to joke that the fact that it doesn't cost $1,000 for a bottle of Coke is amazing.
It's amazing.
Goodness. All of the energy and effort that goes into, they are, and this is going to be a little bit boring for people who aren't in the industry, but they are what they call a DSD supplier, which means direct store distributor. And nobody touches that product until the consumer picks it up off the shelf. Coca-Cola, it's in Coca-Cola's hands the whole time.
Yeah.
Right? But to operate that kind of supply chain is expensive. When you go into a national retailer, people don't understand that you mentioned slotting fees. It costs money to get positioning on the shelf.
Mm-hmm.
It costs money to be on the end cap, which is the part when you're shopping in the grocery store and you go around the corner and there's things displayed there from one aisle to the next. It costs money to be in the front of the store. It costs money to be in the circular. Everything costs money. And if you're a small business and you're like, great, we landed a placement at Target, I'll use Joyride, right? Ryan Trahan has been on a quest to make Joyride the #1 candy in Target. And people don't realize that it's more than just making social media videos. There's a lot of expense to getting to that #1 slot.
Oh, yeah.
In the in what you've done, what has been the most surprising to you when it comes to capital need, getting into those stores and into that prime spot, that prime positioning?
Oh man. I mean, I think what's most surprising to me is when founders aren't prepared for the cost or they're not doing their pricing correctly. And that's a huge thing is once you set your price, that's kind of your price. It's going to be very difficult to go back to your buyer and say, we need to increase our costs. Or you set your price with Target and then Target sees that you're selling it on Walmart for another price. So you really need to know what your cost of goods are going to be. You need to understand what the promotions are going to be. You called it out on circulars. If you're in a Costco circular, that could cost you $25,000 for 6 weeks of runtime there. And sometimes they require it for certain products. So it's reading I'm surprised when people don't read the contracts that they're signing. They don't read the fine print of what could actually be in the discounts and deductions. A lot of people work with brokers in the CPG space, and they don't understand what the implications of some of those discounts and deductions can actually be. So as a founder, not only do you need to know your numbers inside and out, what your actual COGS are, and what buffer you can build for people, but you also need to know the terms and conditions of the retailers that you're working with. A lot of big box stores will go based on forecasts. And I was talking to a company recently where they have a frozen product. And when the buyer was initially doing their forecasts, they just did a forecast for overall frozen goods, which can include ice cream. It can include frozen veggies. It can include frozen treats like pies. And they had a
And there's
very
seasonality to some of that stuff.
Exactly. And so what always surprises me is it's this fine line of wanting to make your customer happy and wanting to accommodate the buyer and this fear of kind of questioning and pushing back because they had a big forecast that I think they maybe hit at 20 to 30%. And that's incredibly detrimental to a business. When you're forecasting $20 million worth of sales and you hit 4 million, you've now spent all this time and effort in this inventory. And if it's private label, it's even harder to get rid of. So really understanding, one, what the buyer expectations are, what your distributor expectations are, but then also what you as a business can sustain yourself. You don't always have to go for the big swings. They don't always pay off.
Yeah, that's very true. And it is so exciting, I know, for small business owners to get that contract, to finally get in, to be on the shelf. There was a company that I worked with a little while ago when I was doing some consulting work, and they so badly wanted to be on the store shelf.
Yeah.
And they finally got into Bed Bath and Beyond, all of the requirements that it took to get into that
The
space.
months of time invested into it, the conversations, there's a lot that goes into it.
And the reason I bring that up is for some businesses, depending on where you're at, look, retail can be amazing and it gives you great exposure and it's something to be proud of. But sometimes just being online, sometimes just getting your product into the psyche,
Yeah.
if you will, without being on the store shelf, that can be very powerful as well. But this owner, he's like, you know what though? There's something like they couldn't get rid of that just internal passion. I'm like, all the money you're spending on getting on the shelf could be better used in marketing online.
It really, people see this marketing expense as, and it's tough, in financing, it's much easier to get lending for PO financing to get on shelves of the big box store. No one's going to give you a loan for marketing. I think in the future, you will be able to. I think marketing spend is very algorithmic. If you can prove that, look, when I spend $5 here, I make $15 there. And this has been the case for 8 to 12 months. And I think we're going to see a lot more algorithmic lending. But until then, to your point, we don't realize the dollars that it's going to cost at the end. We see the marketing cost up front when it's D2C, but we don't see the actual big box discounts, deductions until later on. So it's just a bill that's been delayed and it's not something that's top of mind.
That's a really good point you brought up about modern marketing metrics. When you do Google AdWords, when you do Facebook, there's a better measure of being able to say this equals that.
Yeah.
You can, if you count on a 2 to 3% click-through rate and a 2 to 3% conversion rate, and if you spend this much money, you're going to get this much exposure. There is some math you can run on that. And if your models prove out, yeah, I can see getting loans for things like that. So let me, on that point,
Mhm.
because one of the things I was reading about Bridge is that it's an organization that really connects you with lenders. So help me understand a little bit more about what you all do and how you help connect people.
Yes, absolutely. So I like to say that we were founded by two recovering bankers. So they started in Citibank and they saw that small to medium sized business banking was broken. Heinz Ketchup can walk into a room and you'll have every lender in North America clamoring over themselves to lend to this business. But small to medium sized businesses don't get that same attention. They don't get that same experience working with banks. It's knocking on doors, getting told no twice and thinking, well, I've been told no twice, and obviously my business just can't get a loan. And that's not the case. With Bridge, a business puts their high level business details on the platform, and lenders are able to review it in real time. They're able to see what the financing needs are, a snapshot of the financials, and they submit indicative terms. So you're able to see what the range of pricing could be. You're able to see what the term of the loan is. You're able to see if there's a personal guarantee required or not. And you can compare apples to oranges of different loan types, whether AR financing may make sense for you, or PO financing, or asset-based lending. You're able to see a snapshot of what that looks like. And from there, if you realize, okay, I think asset-based lending could make sense, we'll connect you with 3 asset-based lenders. Because on top of that, not only are all loan products not created equal, not all lenders are created equal. They're all going to have their own credit box, their own pricing structure, and you're able to go in and compare terms, apples to apples, of what makes the most sense to you. Does one lender have a high early termination fee, and this is only something you're wanting to use for a year? Does one lender not require a personal guarantee and you'd rather do a validity guarantee? We help businesses navigate the best loan structure for their business and then get the best terms for them.
As you explain it, and I'm very pragmatic, right?
Mhm.
So I'm like, wow, this is like Rocket Mortgage for small business. In that, conceptually, what you're doing is you're taking a profile
Mhm.
and you're linking them up with the right people for the right product. And as a business owner, I imagine it takes a lot of the legwork out of it, because founders, people who are running the small business, honestly, they would rather be running the business than worrying about all of this stuff. So it's an easy one-stop shop that you can go to a place like Bridge and get connected to the right people.
Yeah, finding financing can be a full-time job. It is my full-time job. It's job security. And to take it a step further, to compare it to another corporation, we have a great, easy-to-use deal room. So you upload your financials, and once you decide to meet with a lender, that's when they have access to the financials. So this TurboTax model, as opposed to sending your financials to 6 different lenders, they're able to easily access it in the platform. And then lots of businesses that I work with, their financing needs change. So in 6 to 12 months, they come back, they upload a new set of financials, and any new lender can access an entire deal room and package of financials that stays there.
So, in your experience, how have you seen businesses leverage their debt strategically? Like, how can they? Because what I'm thinking about are like the debt you have to take on when you have a large purchase order,
Yeah.
but you don't have necessarily the funds in the bank to cover the cost to make the product, right? You kind of need that bridge to get you there.
Yeah. I mean, my rule of thumb is use debt for the things you can get debt for at the end of the day. So if you can get debt to finance a PO, or you can get debt to free up cash that's tied in inventory, do that. And then that way, the cash that you have on your balance sheet or in your bank account, you can use for things like insurance payments, like things for logistics and freight costs, or hiring a new salesperson. No one's going to give you $10,000 to go hire a new salesperson. You need to be able to use the debt for the things you can get, and then use your cash for the things you can't get debt for. So with AR financing, when you give a customer terms, you're in essence giving that customer an interest-free loan to use your money at the end of the day. So if you give Bed Bath & Beyond net 90-day terms, Money isn't sitting in a lockbox with your name on it. They haven't written the check and it just sits there. Bed Bath & Beyond is using your cash to pay their people, to pay their insurance, to cover their costs. When you
Yeah.
use a tool like invoice financing, you're able to bring that cash in earlier, reinvest it into your business, the cash that you deserve, at a small discount to a factor. And your cash conversion cycle goes down. So as opposed to, 2 months where you're paying for the goods and then you deliver 2 months later and then you're waiting to get paid in 90 days, that's a 150-day cash conversion cycle. Heck, if you could get PO financing day one, pay it off through the invoice as soon as you invoice, your cash is turning a heck of a lot quicker to reinvest into things for the business.
Yeah, because I guarantee you and I'm not going to call anybody out by name, but if you have 90-day terms, they're waiting till day 89 and a half,
100%.
11:59 before you get your cash.
That's exactly it.
It's
And some people only process payments on the third Tuesday of every month. So even if you have
yep.
net 90-day terms, that third Tuesday might be 2 weeks from now. So add that on top of it.
Yeah, it can be a little rocky sometimes getting things right, and the experience that I had in people invoicing me and us having this. By the way, there's a whole process to it for those who may not know as well, because first you have to be a vendor, then you have to be in their system, then you have to go through all of those iterations before you can even get on the schedule of getting paid on the second Tuesday of every
That's
month, right?
exactly it.
It's quite a bit. When you think about finance options that businesses have, so you're a great spot for people who can't necessarily go through traditional banks, if you will. How does your lender network differ in those ways? What are some ways that businesses can kind of grasp onto the opportunities given some of their niche situations they might be in?
We have over 200 active lenders on the platform, all with their own credit box, all with unique product options. So we're very industry agnostic. Yes, my background is in CPG, but to that point, we work a ton with the 7A loan product for a lot of our franchise businesses. So we have lots of different lenders on the platform, all again with a unique offering for businesses or a unique pricing structure or credit box. So borrowers, regardless of industry, can come on and use the platform and find loan options for their business.
So you mentioned a couple times that people can go online, they can upload documents, other lenders can come in and see that when they're ready to do that. What are some of the technology opportunities that you guys have available for people, or you've probably seen quite a bit change in the time that you've been doing this stuff?
Yeah. So when it comes to lenders and the way they're looking at things, or the bridge platform specifically?
Maybe how about we'll start with the platform and then maybe with lenders as well.
Yeah, we're seeing a big revolution in tech and banking right now, which is quite an oxymoron. So, banking and lending has always been archaically slow to adapt and embrace technology. And that was really important to bridge that we make tech that makes sense. So, we're not making change for the sake of making change. We're making things really easy to use, really easy to click through. The RFP takes 10 to 15 minutes, and the RFP being your request for proposal. So, this high level business summary. We're asking the important questions that lenders care about the most. So we're ingesting the most important information that a banker is going to look at that probably would have taken him 3 to 4 weeks to collect from you directly. We're able to do that in 10 to 15 minutes now on the platform. So if you know your numbers, you have your financials, this is something that's really easy to fill out. And we know different loan types and different industries are going to have different questions. So depending on the loan type that you're seeking, we have very specific questions for those that then lead into a decision-making tree of other questions. So you're building out this high-level summary of your business in this really tech-forward way without even realizing that you're doing it.
So when you consider how businesses today, like some of the needs, so take, for example, we just went through a lot of wild gyrations with tariffs. How did you see some of that? Because immediately there were companies that were like, wait a minute, I got to finance the inventory that's on the water coming in, right?
Yeah.
So How quickly were you guys able to respond to stuff like that?
Incredibly quickly. We went to our lender network and we found out, what are you doing? What are you changing? Some lenders stopped lending. Some had to change their credit profiles. So we went out and found the lenders that were going to continue to deliver. And to that point, companies weren't anticipating this raise in costs. So companies that didn't need financing before needed it more than ever. So we were there to deliver and get them matched up with the lenders that were prepared to take on this uncertainty during the time of tariffs. And we're certainly not out of the woods now, but businesses are thinking about their COGS in a very different way.
Yeah, it's hard for some companies. I'm going to focus specifically on China right now because it's as the wind blows, the tariff rate just keeps fluctuating. If you're heavily based in importing from China right now, it is so tough to know from one month to another, how much your inventory is going to cost.
Yeah. I mean, I will say something that I saw that was maybe a blessing that came out of COVID was diversification in manufacturing. So we kind of had some companies that were a little ahead of the curve of being fully dependent on China. So we saw people starting to diversify in Vietnam. Some people moved to Mexico and they were able to kind of pivot. Some even went to Europe and able to pivot. And they'd done this a couple years before. So they weren't completely impacted by the tariffs. But we have even seen some suppliers starting to explore manufacturing in the States because it is becoming cheaper for them. The limitation is obviously just the factories that are here that can deliver in a cost-effective way, but a lot of people are starting to consider it now in a bigger way than we've ever seen before.
As you think about the many folks that you have in your network, is there a type of loan that you feel has kind of been underutilized?
Oh gosh, I think PO financing is one that's been underutilized because it's very high cost. So purchase order PO financing, purchase order lending, it's not the cheapest loan option in the market. Can you go get a 7A loan, for prime plus a couple points at a 10-year term? Yeah, but is that going to be enough for your business? The 7A loan sizing is going to be very different than you've been selling to Walmart $50,000 a month, and then out of the blue, they order $350,000. Your bank's certainly not going to increase a limit in a timely manner, nor is the SBA. PO financing is a great tool that scales really quickly with your business, but it comes at a cost. You're looking at APRs in the teens to maybe 20s, but the alternative is equity financing. So what you're diluting in ownership, what you're giving up in margin. So you save the equity in the business, but you give it up in the margin on PO financing. I just think sometimes businesses have sticker shock to what the cost is because, to that point earlier in the conversation, we talked about the slotting fees, the discounts, the deductions, the broker fees, everything there. You think, oh gosh, one more point off of my invoice that I'm going to be submitting. But it's something that scales really quickly and allows you to continue to deliver to your customers in your time of need.
Thinking about, kind of along those lines, the types of businesses that you guys have worked with, and consumer product goods, pardon me, can be such a vast space, right? It's everything from food to take home products to things you'll use in your backyard. I mean, it's a lot of stuff, right? Of the companies that you've worked with in that space, what would you say are the things that they most often use? Like those CPG companies that first reach out to you, most of them tend to do what first?
A lot of them tend to have some really crappy debt. So we're seeing this in the market right now. They were called MCAs, or merchant cash advances. And then they had this rebrand called revenue-based financing. And this financing can come in at the low end at 30% APR and comes in as high as 56% APR. Sometimes it's 100%.
You said low end 30%.
I know.
That's crazy.
It's crazy, but it's easy money. It doesn't require this intensive underwriting. It doesn't require a full financial credit package. It sometimes doesn't require a personal guarantee. So these businesses have been very used to getting, typically the revenue-based financing is sized on your trailing 12-month revenue. So you're getting access to 30 to 40% of your TTM, which is a great loan size. It's much bigger than a bank is going to give you, and it's much easier than, getting a bank line. But you start paying it back weekly or sometimes monthly if you're lucky, but it kills cash flow for businesses. But again, it was easy to get, and that's why the borrower got it. It can maybe take as quick as 3 to 4 days to get this money, but at what cost? Because it makes it really hard for a sophisticated lender with good rates to come in to refinance this out, because the company's cash position is now decimated. They're trying to stay above water to service this high interest rate, and it scares other lenders to see. And to that point, borrowers just say, well, hey, I could go get $200,000 from an MCA lender. It's going to cost me a lot, but it's not going to take me 3 weeks to get. And honestly, 3 weeks is a really quick time to get a loan. And I say this all the time, and it's so cheesy, but there's good, there's cheap, and there's fast, and you're not going to get all three. So those MCA loans, it's fast, but it's certainly not cheap. And it's definitely not a good loan for the business. So we see a lot of that. We see a lot of businesses that have started to stack bad debt because they haven't taken the time to get the good debt, because they would rather take something in 7 days than maybe wait a couple of weeks.
In the project management world, we used to say it can be fast, it can be good, or it can be cheap. You can pick two.
Exactly. Maybe two.
And those are your options. So what I would love to know is, this is one of those areas where we started off talking about it, where, not everybody loves talking about money and getting into finance, and there's a lot of exposure that you have when you do this. What are some of the things, I hate to call them mistakes, but let's just say errors in judgment that could have gone better?
Yeah. I think sometimes counting on your accounting person too much. So you get a business owner on the phone with a banker or with a lender, or even myself, and you have questions on the numbers, and the owner can't answer to that. That's a big red flag, that you shouldn't have to call your accountant to understand why something is happening or why something is the way that it is. It's really key as a founder to stay on top of your numbers for many, many reasons. But one is, it's your business. And if a lender has a question, they're not going to go to your accountant to be made whole for the loan. They're not giving your accountant the loan. They're giving you the loan, and they want to make sure that you understand what your numbers are and you understand the basic functions of your business. When they see that COGS went up 20% for 2 months out of the year, and they want to understand why, and you can't point to it, that's something that's going to give the lender pause. They're going to want to know that you as the founder can pivot and turn things quickly and understand what's happened in your business, because understanding the past of it really paints a picture for what their future could look like.
Yeah, it's so very important. As you were talking, I was thinking about the number of instances where I had great experiences working with people. I remember there was a national chain we were meeting with in Indiana, and I swear any question you asked about any store in their chain, and they had probably 600-800 locations around the US, you could ask any question, and this person knew exactly the store, not just the store, but the stores around that store, what their monthly revenue was, what their average ticket was in sales. Like, just a wealth of knowledge. Didn't need a computer, just knew it.
Yep.
Just could recall it in a moment. And it tells you very easily, that's not somebody you're going to get anything past. Like, you've got to be very diligent about the information you provide. Then I've come across some people who have no idea. I had a client I worked with one time, and I said, what are you using for your books? I said, are you using QuickBooks? And they said, what's QuickBooks? And it was like, wow.
Yeah.
Where we're starting, huh?
Yeah. Yeah.
And again, that's very small business. Probably nobody in this
but
crowd.
Even then, as you grow and as you scale, you have your controllers, you have your CFOs. It's no longer your job to manage all of that, but it's your job to know what's happening at the end of the day. Right. It's your job to know why your freight logistics costs went up so much. It's your job to know why Walmart hasn't paid, they're paying 20% of what you're invoicing them for. It's your, you don't
what
have
does
to
your
be in
aging
charge of
report
all of
look
it.
like?
But yeah, you need to know what's going on.
Something as simple as knowing who hasn't paid you can be very powerful information.
And it's as easy, it's much easier to stick your head in the sand and say, it's someone else's job. There's still cash in the bank. It's okay. But I talked to a business the other day. She thought everything was great until she calls her accounting firm because she hasn't gotten her financials in 3 months. And the guy that was doing their books was fired and no one reached out because he was doing a terrible job. And so you never want to become too reliant on other people, especially when it comes to the money at the end of the day. You really want to have a finger on the pulse and the numbers and what's going on.
So let me ask you this. So we visited a little bit on the dark side of things. What are some of the, like, when someone reaches out to you and they just have everything, like all the ducks are in a row and you're just like, wow, this is going to be so easy. What does that look like in your world?
I wish that happened. It never does. There is nothing easy about finding financing. There is always something. There will genuinely always be something. Even as the stars align and it's a great company, there is always something. I think if we had to think of best case scenario, it's a founder who knows what's going on. It's a founder who understands they've built a strong business. And especially in the CPG space, it's pay to play. It's someone who understands the importance of profitability. It's someone who understands that having 50% margins is kind of a minimum these days. If you have anything below 50% gross margins, you're going to have a really hard time. There is this question that was once asked, and I'd love to ask this in interviews now, what business would you prefer to build? A cupcake store because you're passionate about cupcakes and you're not really great at the numbers of the books, but you love cupcakes and you want to build? Or a sock company, maybe something you're not incredibly passionate about, but you understand the economics of scale around socks and you can build this in a really great way. And most people pick the cupcake business because they think that their passion is what's going to drive them to success. But I'm drawn to the sock company. I like the people who understand what sells and makes sense. Like, that's a great company. It doesn't need to be the sexy, exciting thing that the founder stays up at night thinking about. It's something that makes sense. And you see a lot more of things in the market that just don't make a ton of sense anymore, that you're just continuing to run and fuel on losses. And at what point do you have to start to pivot? Because passion isn't the thing that's going to propel this to success. It has to start to come down to the bare brass tacks of the business fundamentals.
That's a very Warren Buffett approach,
Yeah.
right? Just a very solid business that earns a solid return, solid revenue. And in contrast, when you think about the entertainment industry, which is all very emotional, very feeling forward,
Mm-hmm.
at the end of the day, though, there is a business to run. There is a revenue and profitability to be made. And as much as we may love it, if the money isn't there, difficult decisions have to be made. I've said this in a few podcasts. Businesses exist for revenue and profitability first and foremost.
Mm-hmm.
And I know that sucks and it doesn't feel good, but that's primarily why a business exists. Because if it doesn't have profitability, it doesn't live.
No.
And all of the other things that we get out of it, the benefits, the 401k, the gym club membership, whatever else comes along, perks of your business, that's all the benefit of profit.
Yeah.
Staff, resources, it's all the benefit of profit. If we can't turn that, then we don't have a business.
That's exactly it. Or, in turn, you're forced to give up equity and dilute yourself and raise money. And then at what point are you running this company for yourself and what your vision was? Or is it now for your investors and the cash that you've taken and this, grow at all costs mentality?
There's probably a couple ways to cut that as well, because there are times when giving up equity and taking on others is going to be beneficial for you. And some strategically, like, that's their out.
Yeah.
Like, they just want to carve out enough revenue, peel away the business, and then ultimately that's it. But for a lot of founders, they love what they do. They love the people. They love the product. They're in it for the long haul. And so easily it can be brought to an end or brought out of your control. So let me ask you this, Emily, and by the way, like, I love your passion and enthusiasm for what you do. You can tell you really, really enjoy this work. If people are interested in reaching out to you and finding you, how do we get in touch with Emily at Bridge?
There we go. You can email me at Reeves, REEV as in Victor, ES as in Sam, at bridgemarketplace.com. I'm on LinkedIn under Emily Reeves. And I don't know, am I allowed to give my phone number here?
Hey, look, it's up to you. You want to give your phone number? I'm not going to stop you, but we don't know who's going to call you. I'm just going to
start with email here, and you can find me on LinkedIn.
Stick with email. Let's stick with email. If you want to contact Bridge, call the switchboard.
There we go.
Emily, I really appreciate your time and what you had to share. I think there's a lot of really good information. And I will say, coming into this conversation, I learned more about your industry and what you do as I was preparing for things. And immediately, that's what I thought was, wow, this is like the rocket mortgage for small business, but having so many options.
Yeah.
And I think what oftentimes kills small business is not understanding what your options were. And I always hate it when people like 2020 hindsight, like, oh, I should have done this or I should have done that. They were afraid to ask for help. They were afraid to reach out. Even if you're not sure, give Emily a call. Let them help you. Let them figure out whether or not there's something that you can do, that they can do for you.
Throughout the day, I hear people tell me, I wish I'd found you sooner. Oh my gosh, we wish we had found Bridge sooner. Everything would have been so much easier.
Yeah, I can see why people feel that way. This is not one of those businesses that we were talking about, like marketing and putting yourself out there. This is one of those like B2B things. And I will say this about B2B, very undermarketed.
Yeah.
When you think about the number of small businesses we have in this country, the number of small business owners, entrepreneurs, whatever that we have out there, and the fact that we don't see a lot of commercial advertising for things like this, probably because the niche is so small and the budgets are not huge. But, at the end of the day, I mean, this is important and good stuff for people to know about.
I love it. Well, thank you for the opportunity for having me on here to talk about it. It's been an absolute blast. Thank you.
No, thank you. I greatly appreciate it. And for all of you who have checked this podcast out, please share, like, follow, subscribe, all that cheesy stuff you always see on YouTube. But we mean it because we're here to help. We're here to spread the word. We're here to help other people get better at what they do. And that doesn't work unless you let other people know about us. Keep it going. Thanks for checking us out. We'll see you next time. Have a good one. Thanks for listening to DissedMedia, A Startup Story. This podcast was produced and edited by Ben Olmos and is a production of DissedMedia Corporation. If you're interested in learning more about anything you heard on this episode, please reach out to us at podcast@DissedMedia.com. You can also get more information about this and other episodes or information about our guests by checking out dailypitch.news, our business and insights publication focused on helping managers, leaders, and entrepreneurs get better at what they do.